Why do investors react negatively to the losses in the financial statements of traditional firms, yet they seem not to be concerned about losses in digital companies and technology firms? Financial statements appear to have become less useful in making investment decisions for digital companies. A big reason for this is that traditional financial statements can't capture the drivers of value in digital companies. The primary drivers of value are usually the increasing returns to scale on the intangible assets. So as a result, the current income statement and the balance sheet have far less relevance in a digital company, particularly one that is yet to mature. If you take a look at the balance sheet of Walmart, for instance, it's $160 billion of hard assets for a $300 billion valuation. If you take a look at the balance sheet of Facebook, it's $9 billion of assets, but it has a $500 billion valuation. The building blocks of a digital company are really research and development related. They are brand related. They are organizational strategy related. They are peer and supplier network related. They are customer and social relationship related, computerized data and software related, human capital related. Now, most of these aren't reflected or capitalized onto the balance sheet. Actually, a lot of the time, they are written off as expenses in the income statement. So the more a digital company invests in building its future, the higher its losses are reported as. What we see today is that investors in digital companies end up disregarding earnings and balance sheets in their investment decisions. So let's take Facebook, for instance. Facebook's value increases as more and more people use its product. The costs, however, for Facebook remain the same. So whether there are 1 billion people using Facebook or 2 billion people using Facebook, the underlying fundamental costs for Facebook remain the same. So Facebook enjoys what we call a network effect. What do we mean by that? Every time a new customer joins, it increases the value of the platform, but there are virtually no increased operating costs. As a result of that, the most important aim for technology and digital companies is to achieve what we call market leadership, to achieve and create a network effect, to command a winner-takes-all profit structure. If you had to start up a, whatever your name is, book, no one would come to it. They're all on Facebook. Facebook commands that particular market. But the accounting statements, the income statement, the balance sheets, it doesn't capture the concept of a network effect. And as a result of that, they are less valuable. Income statements, balance sheet in the traditional sense have significant limitations when it comes to digital companies. Now, investors and practitioners know this, and they are using alternative measures on performance and on valuing these technology companies.